What's up everyone, it's Scotty with MoneyVest. So in today's video, we are going to be talking about four companies that I do strongly believe are going to be at much higher prices 1 year from now than they are today. And we're going to be taking a look at each and every single company. I've kind of compiled this into a nice visual bar graph that you guys can take a look at. And we're going to do some comparison analysis. And I'm also going to share over why I believe that these stocks have a ton of potential, not only in the next 1 year, but also long term. Now, in terms of intrinsic value, I have calculated intrinsic value for each and every company separately. And some of them may require the stock for it to come down, let's say 20 to 25%, because there's a margin of safety built in by another 10%. You could, consider doing some additional research and analysis to see if it makes sense for you at today's market prices. But for me personally, I have listed out exactly where the fair values are and why I believe that the valuation or the conservative analyst growth rate is appropriate for that stock. So hope you all enjoyed this video and find it helpful. Make sure that you drop a like and of course subscribe to the channel if you're just joining us for the first time. And don't forget, we've got that 51% discount. I opened up a few more spots this morning because I've been getting a lot of messages for people to join this MoneyVest beta launch. We've got a 51% discount right now, and you can access the entire platform, do your entire fundamental analysis, including individual stocks, visually look at companies' metrics, revenues, earnings, profitability, cash flows, margins, whatever the case might be, and also use our analyzer tool, so discounted cash flow, discounted earnings, multiple models, to really figure out what the intrinsic value is for each and every company. Now, the reason why these four stocks specifically I'm going over in this video is because they all have one thing in common. They were for the longest time loss-making companies that are now turning the corner towards profitability. These are four companies that have now, over the last 2 to 3 quarters, have now shifted the entire business model, and they're now focusing on profitability, and they are now on the verge of becoming profitable on an annual basis, which is very, very important for any business to survive. Ask Wall Street, ask any institutional investor, ask any long-term investor. A few most important things that they're going to be looking for is positive cash flows and positive earnings. In other words, actual profit. Is the company making profit? Because if the company's not making profit, its days are going to be numbered. If the company has a path to profitability, then eventually it is going to, once again, have to execute. And if the execution's correct, if they actually turn the corner towards profitability, that's great. That's exactly what investors and everybody else wants to see. It's a self-sustaining business. So this right here is the quarterly numbers for those four companies. We've got 4 bar graphs over here. And you'll notice that for the longest time, except for one, you'll notice that the blue bar over here, this company was already profitable. The other 3 were a loss-making company. Same thing happened in the first quarter 23. Same thing happened in the second quarter 23. Same thing happened in the third quarter 23. And then look at fourth quarter 23. 2 companies started becoming profitable. 2 of them were still loss-making. And look what happened. First quarter 2024, all 4 of them are now generating a profit. The blue and the orange have just been generating profits for 2 consecutive quarters. The blue, of course, 4 consecutive quarters. But these 2 right here are the 2 additional companies that are now making a profit as well on a quarterly basis, and they've also guided for some net income moving forward. Now, these companies are going to be Palantir, SoFi, we've got Zscaler, and we've got Team, which is Atlassian. I'm going to break down, I'm going to give it to you all of them in one single go. And this right here is essentially the net debt. So right now we're looking at the net debt for companies, and right now you'll notice that every single one of them has more cash than debt on the balance sheet, and that's exactly what we look for. Palantir has $3.6 billion worth of net debt negative, so that's very, very solid. They've got more cash than all liabilities combined. SoFi, negative $700 million. Zscaler, negative almost $1 billion. And Atlassian, which is a project management tool that I'm actually using myself in my own company, negative $900 million in net debt. So every single company here on the list has more cash than debt on the balance sheet. One of the most important metrics we look for when it comes to financial health. This right here is going to be the 1-year revenue growth. And even though it has come down for almost all the companies on the list here, so from 57%, 27, to 17%, they've all kind of converged to this number between 20 and 40%, because as the numbers get bigger and bigger, growth rates do come down, but nonetheless, they are all growing at a very solid rate of over 20%. Some companies more than others. SoFi at 37%, Palantir is the only one at 21%, and Atlassian and Zscaler at well over 29 to 32% respectively. So long-term growth on a one-year basis, very, very strong. Negative net debt, so more cash than debt on the balance sheet. And then this right here is going to be both the revenue and of course profitability in terms of margins as well. So if you take a look at the first quarter 2024, you'll notice $975 million in revenue, and this is going to be for, let me just take a quick look, that is the revenue for Atlassian, and gross profit margins of well over 82%. Most of these companies are doing well over 70 to 80% gross margins, so 84%, 80 to 81% for both Atlassian and SoFi. Palantir 78%, 84% for Zscaler, so very, very high margins with very nice consistent revenue growth for the company as well. And this right here is going to be the current ratio, with Palantir, of course, leading the way at well over 5.9, almost 6, with 1.7, 1.2 for all the other three companies. So what have we discussed so far? These are companies that have very high revenue growth rates of well over 25 to 30%, current ratios of well over 1, close to 2, in some cases almost 6, negative net debt, meaning more cash than debt on the balance sheet, and the most important piece of the entire puzzle, they have now started to turn the corner towards profitability. And that's exactly what Wall Street loves to see, is profitability. Now, moving forward, this right here is going to be the valuation on a forward price to earnings multiple basis. So what you'll notice is that almost all of them arguably are trading at much higher multiples, of well over 50 to as much as 70. And that is, again, because of the earnings being low, or they are just turning the corner, they're trading in cents. That's why the price to earnings multiple on a forward basis is, of course, higher for these companies, but eventually these numbers are going to come down. And the reason being is because as numbers get bigger and bigger, as profitability and margins grow, price to earnings multiple is going to compress. It's going to normalize a little bit closer to at around 25 to 30 levels, right? So that's where it's going to normalize and stabilize a little bit in and around those levels. But right now, of course, trading at a little bit higher number. Moving forward, this right here is going to be the price to sales. And again, you'll notice that a lot of them are actually trading almost identical to each other. So more specifically, Palantir, of course, very, very high price to sales multiple, as opposed to Atlassian or Zscaler, SoFi closer to 3. But eventually, I do expect these numbers to also come down, stabilize sub 10. And the reason being because, again, as revenue grows, revenue is going to be growing at a much faster rate compared to market cap. And as a result, we're going to see these numbers compress even further down. But no doubt, on an absolute basis, valuations are a little bit more on the expensive side for these companies as well. So starting with SoFi, this right here is going to be my intrinsic value. So what I've really done is that I've accounted for 2024 all the way through 2026 earnings per share growth, and that's about 126%. So obviously, we're not going to use that number. If you go with a conservative 35% growth and a 30 times PE multiple, we arrive at an intrinsic value for SoFi at $6.18. And right now, the price at $6.43. That means only about a 4% downside needed in order for SoFi to be trading at its intrinsic value. Again, this is just a conservative way of analyzing a company for the long term over the next 5 years, with a price target of well over $12 per share, representing well over a $100 increase in share price, almost a 96% increase in total return estimated for this company. This right here is going to be Atlassian. And again, Atlassian, I would definitely recommend that you study more about the company. It's got huge potential, packaged software with project management features. And this right here is the growth rate that I've plugged in, 22% with a 25 times PE multiple. Now, this is a stock that does require to come down a little bit, over 35, 36%. So sub $100 would be ideal. I'm going to be going over the technical analysis for these 4 companies as well. We'll be taking a look at where the support and the resistance levels are. But sub $100 is, in my opinion, the intrinsic value based on conservative estimates of just over 20% growth rate and a 25 times PE multiple. Palantir, we've also analyzed before, 25% growth rate and a 30 times PE multiple. We're looking at a $15 fair value, which once again only requires a stock price to come down by about 34 to 35%. Again, we're going to go over the technical analysis in just a minute, and that's exactly where the support also sits. Now, many people may argue, be like, 34% is still a pretty decent drop. You know, why would I wait for Palantir to drop down to that level? You could still start a position here, even at these prices, because my long-term target over the next 5 years has come down a little bit, and that is subject to change depending on how the company grows in terms of earnings and revenue and profitability and all that stuff. But right now, it's closer to $31 for a price target for Palantir, with a $15 fair value at the moment. Now moving over to Zscaler. Zscaler, my intrinsic value sits at just under $140. There's been some updates with this as well. 24% potential downside needed in order for it to be trading at its intrinsic value. Right now trading at just over $182 at the moment as well. So coming back over to the analysis on a technical analysis basis. So this is going to be Zscaler with the fair value sitting roughly at 140. This right here is going to be the most important area of support. Of course, we've been coming down a little bit from its recent highs. It's dropped over 29, almost 30%, but just another 15 to 20% drop here, and it's going to be trading in the 140s, and that's exactly where I believe is going to be a lot of support, and also the risk reward is going to be much better for Zscaler at those prices. Palantir, on the other hand, again, $15 is going to be that intrinsic or that fair value, and that's going to be aligned with this right here. Very strong area of support. This is exactly where we were kind of consolidating sideways before finally breaking out to the upside, and then a much stronger another support area at close to $20 for Palantir as well. SoFi is now starting to break down a little bit below its support. So I'll keep a close eye at the next potential target where the risk reward is going to be the best for this company, sitting roughly at $4.50 to $5 a share. And right now we're starting to see a little bit of a breakdown below this level for SoFi as well. But of course, my fair value is going to be in and around these prices at the moment for this company. And then finally, we come over to Atlassian. You'll notice that Atlassian here also starting to sell off pretty aggressively from its highs of 260, is down almost 40%, and from its all-time highs, the stock is down considerably. It's down over 67%, and again, the fair value for Atlassian is going to be sitting at around sub $100, and that's also going to be aligned with this support over here at around $114, $115. A very strong area of demand for Atlassian in and around those prices. So it's kind of validated here in the past, and you'll notice that it bounced off of that level back in December of 2022 as well. And if you come over to the quarterly numbers, just recently turning profitable, over 1% net margins with a net profit of just over $12.5 million. So that is going to be that support level, very strong level, close to $114 to sub $100 for Atlassian. So let me know your thoughts down in the comment section below. And what do you think about these four companies? I strongly do believe that Palantir, SoFi are going to be on the higher conviction. Zscaler and Atlassian a little bit more on the expensive side in terms of valuation. But like I said, long term, because of the fact that they're turning the corner towards profitability, there's going to be more institutional involvement, and the price to earnings multiple is going to come down as profit starts to increase for these two companies. In fact, all four of these companies. So hope you all enjoyed this video and found it helpful. Make sure that you drop a like and subscribe to the channel. Again, links to our Discord and Patreon is going to be down below if you want to access the MoneyVest platform and get a 51% discount. Links going to be down below with a limited time and limited spots available. So always happy investing, and I'll see you all in the next video.